Welcome in, everyone, to another episode of the Real Estate Tax Playbook, where we discuss all things real estate, providing timely and precise information to listeners looking to build their own customized tax planning playbook. As always, I'm your host, Evan Ross, tax director with Brown Edwards and Company, based out of our Roanoke, Virginia office location. For those of you still unfamiliar with Brown Edwards and Company, please go check out our website at your convenience. A link to that website can be found in the description of this podcast. On the website, you'll find more information on our service line providers, our 13 office locations, as well as some of the other services we can provide to you as a taxpayer. With that, I'd like to introduce our guest for today. We have Jerry Dunnavant with Covenant Real Estate. Jerry, thanks for being here today.
It's great to be with you today, Evan. Glad to be
I know we
here.
had to deal with a few technical difficulties getting things started today, but we got through it, and here we are.
Well, you know that old adage of technology is great until it's not, and that kind of happens as you kicked off the first of the year here.
Yep, that's exactly right. So we're going with the punches and making it happen. So again, I appreciate you being here. Before we get started, I'd love to just hear a little bit more about you, your background, and what you do for Brown Edwards as well as Covenant.
Sure. Appreciate the opportunity to be on with you, Evan. So, a little bit of a split personality, you could say. As Evan has said, I serve as founder and president of Covenant Real Estate Services, which is a real estate title and due diligence closing operation, handling real estate closings on commercial front and on residential front, as well as land development and working in that capacity. But I also wear the hat as Chief Growth Officer for Brown Edwards. Covenant is a affiliated with Brown Edwards, and we've been able to really partner up to be able to serve clients on both fronts, some of which come in through the Covenant side of things that we were able to introduce Evan and some others to be able to assist on real estate, tax, and other services. And then on the flip side of that has been the Brown Edwards clients that we're able to service when they're acquiring or disposing of residential or commercial properties, working with them as Evan has and some of the other partners associated with being able to get that closing done, being able to get the due diligence done, as well as working on things like serving as an intermediary on the 1031 exchange, facilitating some of those with our partners, IPX 1031. So get to play in two worlds, as I like to say. I was a finance and a marketing major from the University of Virginia, so I get to really use both sides of my brain a lot in the roles that I play.
Yeah, you just had to throw in that UVA line in there.
You know, that was just for you, Evan, just for you.
For the listeners that don't know, I'm a Hokie, so we got a little bit of a house divided here today.
But it just shows how we can all just get along.
Right? Except on game day.
Exactly. But especially this year was a wonderful day.
Yeah, for you. So anyways, yeah, appreciate you being here, and obviously the relationship we've kind of built. I've got to interact with you both on the business development marketing side, as well as, like you said, with some potential prospects, clients, as far as closings and real estate structuring and strategy. So awesome. Well, appreciate that little intro. I know we had a little bit of a dilemma trying to figure out what your Tell Me More segment was going to be about. As always, we have a quick little segment to start the podcast every episode called Tell Me More. Love to hear about what's going on with you lately. What's on your mind? What do you want to talk about?
So two things, as you said, it was a little bit of a challenge when you asked me that question because I like to fancy myself a little bit as I have a lot of diversified interests. So when you start thinking about that, everything from, love to fish when I get a chance to do that, to spending time outdoors, hiking and biking and kayaking and enjoying that when the weather cooperates. And of course, we're looking at right now, as we record this, looking at the prospects of a big snow, which could be a lot of fun too. On the Tell Me More side of things, one of the things I think a lot of people don't realize is, of course, I did mention, I'll say this for your benefit again, Evan, is I went to the University of Virginia. Prior to that, I was in banking, even in a community bank environment through high school, and kind of worked on that. Grew up in a smaller community in Southern Virginia, a town called Victoria, but quite frequently worked in tobacco fields. And people don't understand what it's like to work in a tobacco field in the middle of summertime. One of the Tell Me Mores that I like to say is part of my motivation to be here today was the fact when you're in a tobacco field in August in 85 to 105 degree temperatures, you really want to find a job in which you can sit in front of a computer and be in an air conditioner all day long. And so that is one of the best motivators I've ever had. And so looking for those things, I have the perspective of being able to look back in time into an industry that really has gone away. It doesn't exist anymore, and maybe rightfully so, but it was foundational at one point. So the dramatic change that has happened from that, but the lessons that you can learn from those beginnings and the changes that occur over a career, I think it's kind of fascinating to be able to see. And I'm blessed to be able to continue on and work with folks like yourself, Brown Edwards, and others. And part of it is just I like to continuously learn. So everything about the Tell Me More is about just keep taking the next option, taking the next challenge, look from where you've come from, appreciate those things, and then look at what the opportunities lie ahead. Because I think we're changing continuously, as we know, with AI and technologies and everything that we're coming about with. So my tell me more is I got to keep telling myself, let's go forward, despite the fact that technology sometimes delays you when you want it to go work for you.
That's awesome. Well put. I didn't know that you had a history working in those tobacco fields.
Nobody should ever have had to do that as far as I'm concerned from a comfort level standpoint, but there's nothing like climbing into a tobacco barn in 100-degree weather and having to handle really dirty tobacco. Made me never want to smoke. How about that?
So you got a little bit of a benefit out of it. Yeah, that compared to my manual labor jobs that I had early on in life, as a teenager and in college, that sounds much, much worse off.
Yeah.
But I appreciate you sharing that. So as much as listeners, I'm sure would love to hear us talk more about tobacco fields and those storage areas and everything. Let's get into the meat of the conversation today. We're gonna talk about the real estate market, what it looks like. So just to kick us off, what does the landscape look like currently? Where are we at?
The landscape currently, from my perspective, is if it's as much of a roller coaster ride day by day as I think anybody could ever have anticipated. And what I'm looking at is on the rate front, Evan. If you look at what rates are doing day by day, right now, I think prime is at about 6.75, which is consistent, and we've been watching what the Fed is doing over time. But when you look on the residential side, you got 30-year fixed rates in the 620 range as of this morning when I looked it up. Last week, it actually dropped down below 6%, which I thought was a good thing. But due to different policy decisions or conversations that are being had, there's so much uncertainty now. You're getting a roller coaster ride of what's there. And that's impacting where we are coming through, I think, looking to go into 2026. So I think you've got some unpredictability about what's there and what's going on. I think it's a good time actually to be in real estate and to kind of be looking forward with this. I had a post last week when the rates dropped to 5.99. I think if you're considering a refinance, you ought to be paying attention right now because you could get into an opportunity where you could get a sub six mortgage at this point. Based upon whatever the day-to-day transactions are happening on the 10-year treasury or what the administration comes out and says as far as buying $200 billion in Fannie or Freddie mortgage-backed securities, which drove the market down quite a bit last week when that happened. And then, of course, we also decided we may want to buy some more real estate and call it Greenland from a U.S. standpoint.
Yeah, definitely. So yeah, it really is a roller coaster. It's interesting how you wouldn't think that quarter of a rate or 1/5 of a rate would make that big of a difference, but that's significant to home buyers.
Yeah, one of the interesting things I saw too recently as we're talking about this is we're coming out of an environment where we had historically low interest rates. We know that, right? So in 2020, 30-year fixed rate mortgage dropped below 3%. That was unprecedented. And it sat there for roughly 15 months in that neighborhood. So you had a whole pendulum swing of people who, if you think about this, who would have never been in the market. That accelerated their buying opportunities. And so, and I'll give you an example. I have a son and a daughter and a a 1-year-old granddaughter that at that time frame in that window of time, were recently married and they were looking to rent another apartment. They were moving from one apartment to the next, and rates went down to 3%, or they're in that neighborhood. It accelerated their timetable as far as being able to acquire a property from what their intentions were because it didn't have enough down payment to really look at it. But to be able to get a 3% mortgage on a 30-year fixed rate enable them to to really rapidly move into the buyer side of the market versus being a renter for another 3 to 5 years. And so that rate environment accelerated the demand early. Then, when everything started to settle down and we went the other direction, the inflation started to show up, quite honestly. You saw it in housing inflation, you've seen it in every other inflation. The pendulum swung back the other direction, and we quickly went, what, to like nearly 8%.
Yeah, around 8, yep.
Right? And so you got that, and so that dynamic has really been it's from my perspective, it's a time pendulum that we're talking about. We accelerated demand into that early 3 to 4% range, and then we killed demand to some degree at the 8% range. And now we're back in that 6% range, so we're getting some normalization around the market. So despite the roller coaster ride as to the day-to-day gyrations within the interest rate plays on about a 50 basis point swing, if you look at it over a 5-year window, we're kind of coming back into a normalization range with what we got.
That's what I was gonna say. I don't know what the average is over time, but I would say around that 5-6% is probably normal,
Right.
for our economy.
And psychologically, I think there's an element there too, Evan. When you look at this, I did read the other day, I think third quarter, there were actually about 21.2%. I'm looking at my notes here, but 21.2% of all mortgages outstanding had a rate greater than 60%, which is slightly higher than the number of mortgages that are below 3%. And that just happened. And so we're seeing that changeover of more that normalization around the 6% number.
Yeah. Wow. Yeah. And also, I did a little bit of research before we got on this call, but people were, I think you mentioned the psychological side, but people were just amazed and upset about going up to 8%. I look back into the 80s when it was on like at the all time high, you were at 17%. So, which is, but predates me. I'm not going to say age or anything like that, but just goes to show that there was a time where it was much worse than it is right now.
So I'll date myself with that because fortunately, I was not buying a house at the 17% level. I know some people were, but I did buy one in 1990 and I got a 10% loan, 30-year fixed at 0 points. And I thought that was the best thing ever. Now, a lot of that goes into the actual acquisition price of the house that we were
Yeah,
buying.
obviously prices were lower back then.
Prices are lower, so you're looking at your monthly payment and thinking of it that way. So you can afford the monthly payment based upon what's there. And so you got a little bit of that because of that increased demand now that drove the limited supply up. We got a little bit of what's called disintermediation between the two now, between the actual monthly pricing payment side and the rate side. But it is, as your point out is, it's really historically not that bad of a rate when you think about a 6% mortgage on 30-year fixed money.
I completely agree. So thanks for touching on that. With that, so obviously rates are going down a little bit. Are you seeing an increase in inventory out there in the market from your perspective?
Yeah, and I think it's somewhat market by market. I mean, if you're looking at Florida, if you look at some of the recent readings in Florida, it's some of those markets where condos were big and hot again, and were built. You're starting to see really some excess supply start to show up in that, and some price depreciation on some of those. So it is market by market. The fortunate part about where our brand Edwards footprint is we're a little bit more never get too high, never get too low. And so we don't have too much of that happening. One of the problems that we had on the supply front is coming out of the Great Recession in, say, 2008 to 2011. We never overbuilt anything. Builders didn't come back into the market and all of a sudden start to do, large tract developments and completely go that direction. It was much more cautious. It was much more custom within the marketplaces we tended to serve. And so we never overbuilt. But what happened is when you get the likes of my son who decided to jump into the market at 3% money, the demand just outstripped the supply at that point in time. I think we're getting some leveling out of that now because builders have come back a bit, right? So you're seeing not only apartment buildings, multifamily that have come into play. A lot of those, I mean, we've seen that within the Roanoke footprint. If you think about the number of units that just been added in the last year on that front, we see that, of course, in the Richmond marketplace. You've got a whole lot of tract development that's happened down in that particular area to accommodate the growth that they're seeing on that front. So the builders have come back and looked at that and said, yeah, we can do this on multifamily, townhomes, and as well as some single family. I mean, we see some single family development with town center type environments and multi-use in that regard. So you're getting that type of environment look as well. The supply is getting better if you look at the numbers. And when the realtors come out with it, there tends to be the listings have continued to creep upwards. There's been this rate lock concern, which the rate lock is people that are at 3% don't want to sell. who would blame them, right? But now that we're 5 years out from that, people's lives go forward. So they have to change jobs. They have to get into environments that would cause them to sell whether they wanted to or not. So I think we're seeing that increased supply for all those reasons I've talked about.
Yeah, I would definitely agree. You mentioned builders and the Roanoke marketplace in particular. I mean, I see a lot more multifamily apartment complexes than I do single family homes. Do you think that's going to continue to be more the trend for the near future?
Yeah, it's kind of fascinating, and don't bet on anything I say because even though I've been in the industry, I came out of banking originally, and then I got into the real estate services related title and side of things in the mid '90s and kind of worked through this industry, starting Covenant in 2016. So I've been owning and starting on the settlement side with that after being in title world. One thing I've learned over that time is what I think I know tends to not necessarily play out. When COVID hit, I would have sworn to you nobody would buy real estate 30 days after COVID, and I was 100% wrong. Having said that, right, I think there was undersupply of multifamily in the Roanoke Valley that I think the pendulum has gone too far on personally. It seems like we have a whole lot of excess units based on what population growth is. There was a study done about 3 years ago that said we were underserved, and I can't quite remember the number of units, but I wanted to say it was something in the 1,500 to 2,000 multifamily units that we were underserved at that time frame. So I think that's why you're seeing a lot of developers come in, even developers from outside the region, outside the state that saw this opportunity. We've got a lot of good growth going on here. If you think about what's happening in Carillion and the bio center that we've got going on there, the med school, is it looking to expand, or was it a meeting last week talking about doubling the size of the med school within the next few years? Cancer centers coming on where we're going to have a proton therapy. So there's a lot of good potential there. Long answer to you saying, I think we have probably seen the cut to the top of where we are on the multifamily front for the time being with what's in the pipeline now. I would suspect you start to see that pipeline slow down.
Yeah, I would completely agree with that. Although I thought it was going to slow down, I don't know, a year ago or something. And I keep hearing about new developments or seeing new developments as I'm driving by. So
So
yeah,
you're in the same boat as me as vet. Don't bet on anything we say, right?
I say the same thing. I dabble in some sports betting, nothing high stakes, but I tell everyone to play my fade because I tend to whatever I think is going to happen, rationalize in my head is not how it ends up playing out.
Yeah, I stay away from all that because I learned a long time ago I am not a good poker player.
Yeah. Yep. Neither am I. It's a little fun, but it's $5, $10 here or there. But yeah, it's I'm not winning much money off that. So
Yeah.
not retiring early. So anyways, so we talked about kind of more on the residential side. Can you speak on the commercial side, what you're seeing there?
Yeah, so a lot of what we do is actually in a commercial space. I mean, the residential gets all the press, is what I say, because people pay attention to that more so. So you're going to get the clicks and everybody talks about it. One thing I like to point out too is residential rates are not tied to prime and Fed funds rate. And people get confused about that quite a bit. Is it influencing? Yes. But when the Fed cuts the Fed funds rate, typically that has very negligible effect on what the 30-year or the 15-year fixed mortgage is going to have. That's more tied to bonding. So your 10-year treasuries is where that pricing is going to come into play. So when you look at the current Fed funds policy, which has been favorable as far as decreasing, I mean, we peaked out at about the prime rate at about 850 in July 2023. We're down to about 6.75 now. So you see the positive trend on that. It's all dependent. We read all the headlines about, what's going to happen with the current administration, what's going to happen with the Fed, what is the inclination right now. Everything is being watched as far as where inflation stands and what's going to happen on that front. We've been in a positive rate environment. And what I've seen is we're at that level where now again it's two variables. It's the time and the rate that's having to come into play on this. People that even commercial front that came in, purchased multifamily, purchased industrial, typically they're not going to be locked in for 30 years, right? You're going to typically get an amortization over 20, but probably a 3 to 5 year call on that. You got to reprice. You're in the repricing cycle. So the good news is the repricing cycle is not at 8.5%, but it's not at 3% either. So where's your cash flow and where is that going to happen? The deals are having to happen. And one thing I would say is, talk to your banker about these. So they're starting to happen. We're seeing more flow of that over the last 6 to 9 months as a result of this. We see some interest because deals work at a 6.75 rate cash flow when you start really penciling these down versus the 8.5 quite a bit. So we've seen some actual new purchase transactions, some new construction that are happening because they will pencil out a whole lot better when you're working with your bankers on that. If you got existing debt and you need to come in and reprice it, talk to your existing banker about a modification on what's there. Sometimes the modifications work better than actually going out to market and trying to reprice and fee that thing up as well. So the movement is there, if no other reason, because of the way deals tend to be structured on the commercial front, but you're in a much better rate trend than where it has been prior to, say, the last 6 months.
Yeah, that's good to hear. So we're moving in the right direction. And to our listeners out there, I am in the process of working on getting a banker on the podcast to kind of speak on the financing side of real estate and what that looks like for them. So that's great. From a closing perspective, the title and settlement side, what are you seeing there? Or you have any stories of mistakes people make? How can they prepare and just make closing more efficient?
Yeah. So closing is one of the big mysteries of life, is like what I like to say, because most people, I mean, unless you're a professional investor, or unless you're in the real estate related business, either on the commercial front or on the residential front, you don't quite do it enough to really understand what's going on there. So a couple of things that I like to always point out is, find the people that you trust to handle the transaction and work with those people. I mean, they're going to help you get the deal done. Be it your realtor, the commercial front, commercial brokers. There's some really good ones out there. Residential brokers, same thing. We work with a lot of those folks as well. Talk to your accountant. I mean, who knows better than your accountant? And this is a selfless plug for Evan, but he's in the business, right? So he knows and he sees what's going on. So I think it's a great opportunity to use your accountant as a trusted advisor, as everybody likes to say, because they're going to see it and they're going to have your interest at hand. So looking at those folks. When you get to the actual closing process, people determine who is familiar with the type of transaction that you're doing, because there could be a lot of people out there that have limited experience on a commercial transaction, and that creates quite often a backlog of communication at minimum. And so when you get into that, you're trying to get the deal done, and you may not be able to get it done in a timely manner that you want to. Similarly with your lender, because there's a whole lot of communication that has to happen between the lender, the processing, the underwriting, the appraiser, the commercial broker, the residential broker, whomever it may be involved. There's a lot of moving parts that's there. So find those people that you value and trust. You could have an attorney involved with the transaction, make sure that they're on board with it so that you can be confident that that mystery goes away. And we kind of take the mystery away as we look out on a covenant front. The other thing I would say is proactively communicate on the settlement side of things, right? If you got expectations about your closing date, let people know. I mean, one of the things we run into a lot is, hey, when can we close this? Can we close it tomorrow? Well, there's a process you can't do it. You can't do it that quick when you just got the contract in. But let people know when is a reasonable time frame that makes sense for you as to when you want to close with that. So proactively look at that. If there's funding that you're having to bring from some other transaction, right? If you're selling a property, if you're getting funding from your investor pool or wherever it may be, let people know about that on the front end too, so that all that can be pulled together well in advance of when the closing date occurs with those things. Kind of that's a big process answer, Evan. I don't know if you're looking at, I mean, some kind of the dirty details of what happens on the closing front, or does that kind of cover what you're looking
I
for?
think that kind of covers. Would you find most people are having that communication and they're pretty much ready to go, or do you think there is it a lot of hand holding from your perspective, getting people to that finish line?
Yeah, it's a lot of communication we have to do. I mean, and some of this too goes to like the other parties that are involved. So a lot of times it's not even the borrower or the buyer or the seller, but you're working through that third party. So that's where kind of I go with make sure if you've got a really good realtor relationship, make sure they're communicating on your behalf. Because sometimes, quite honestly, they break down, and then on the settlement front, we're not in the know, and you think we should be in the know, but we're not, because we haven't been communicated to by your lender or your borrower. I'm sorry, your broker. So make sure everybody, from me as a buyer standpoint, having done these things, I want to make sure everybody is communicating to each other to get it done. I don't necessarily have to be in the weeds of doing it, but just so that communication from all parties is on it, and I'm advocating on my behalf for that.
I completely agree. We deal with the same thing when clients are selling a business or something like that. We're dealing with the attorneys, the bank, ourselves. The client thinks we're all communicating and I know everything. That's not necessarily the case. I may not have seen the legal documents that the attorney, I may not have the updated valuation or the updated sales price that they're looking at. I think it goes for all types of transactions. The communication is key.
You're right. I mean, and that's it. I mean, what 90% of life is communication, or I mean, it's something like that, right? I mean, because when you're doing all this, the complexities, there's a lot of complexities, a lot of parties that are involved with it, and so as you look at it, it's easy to understand, particularly when you as a professional, me as a professional, other attorneys, everybody else, they got multiple clients that they're trying to do this for, and so some of it is there's most of the time there's nothing intentional that's not being communicated. You run into this, right? It's that people have a lot going on in today's world and how the communication happens. And so if you have one transaction to think about, Covenant may have 30 transactions to think about. So just kind of helping that process along the way as an example just makes things go smoother for you, is what I would say.
I agree. So, well, we went over a bunch of stuff today. Interest rates, the market, what it looks like right now, as well as the settlement process. Anything else you want to add to the conversation as it relates to real estate and Covenant and what you're seeing, or anything you want to add in?
Yeah, so I think a couple of things come to mind. There's a whole lot of talk about affordability and workforce housing. And so, like a lot of times when you think affordable housing, you're thinking of low to moderate income type housing. Affordable housing in today's world means really middle market housing for workforce. And so, I was at a event yesterday, and actually, a gentleman was talking about doing some nice project here in the Roanoke Valley around the old Norwich Foundry site. And they're going to put some affordable housing units into that. These are going to be townhomes, attached townhomes, beautiful little project. And it's geared towards teachers and firemen and policemen and nurses and kind of that affordable workforce type of housing. And they're using LIHTC, to moderate income housing tax credits, as you can talk about, to be able to pull these together on things like employee assistance for down payments, those programs. I think there's a lot of creativity coming out now to help with workforce housing options and being able to make that funding because of the really the inflationary values of what's there to be able to build a house and pulling it together. Considering the tax credits, considering what's going on in the affordable housing market, looking at where employee assistance plans, if you're an employee, those things are all real, and I'm not sure they're getting communicated out there. I heard there's legislation being proposed by a local representative where if uh, people who are 65 or older have rental properties, sell that property, and the property is sold to a first-time home buyer and it's less than $500,000, that there would be no capital gains tax on that. That's kind of dramatic if you really think about it. And how much does it influence the market? I don't know, but there are things like that out there. It hasn't passed yet. I want all your callers to call you
Yeah.
in if they give me that deal yet. But I use that just as an example of what's happening in the market. So if you're in those spaces, pay attention because there could be real good opportunities when you consider what's there. The other thing I'll bring up is if you're in the market to sell and you're looking at how do I make something cash flow, don't forget about all those other services. I think Evan's had some others on here talking about this in the past, but tax deferred exchanges are a beautiful tax option that's out there. If you're selling a property and you want to reinvest in other properties, we serve as a qualified intermediary on that. Working with our friends at IPX 1031. It's a great way to be able to delay, if you will, the tax component that goes into transactions like that. Cost segs and cost segmentation and looking at that, Evans, he's in it deeper than I am, but we see those things within the transactions on the commercial front that actually make things work. And so just including all of that just to help the listeners and folks that are interested to think about these things that would actually lead to affordable projects, affordable housing, things that cash flow, things that would work for you as you're in the real estate side of the world.
Yeah, Jerry, thanks for mentioning that because a lot of those things that you just mentioned can help get the deal done ultimately with investors. But again, we have some early episodes about cost segregation as well as 1031 exchanges. So please go check those out if that's something you're interested in, or reach out to me. I'm happy to discuss those things. LIHTC, we have not had an episode pertaining to that, but I think it's a good opportunity. That's something that hasn't been prominent in the Roanoke area historically, but you're seeing more of it. So for the reasons you mentioned, Jerry.
I think there's some creative things. I mean, I was learning a little bit more yesterday about this, and I think some creative things that are happening around these types of projects that we'll see more of in our footprint to be able to say, yeah, look at how those deals is working now. So I'm encouraged about that.
I agree. Well, I think we can go ahead and wrap up this episode. Jerry, I do want to give you a chance just to provide your contact information if you're comfortable. And if listeners have questions, they can reach out to you.
Absolutely. So as I said, I wear two hats, and so you can reach me in two different ways. For the Covenant side, Jerry at covenantreal.com is my email. You can reach me at, really, you can call me at cell phone at 540-529-2231. On the Brown Edwards side, if you're interested in talking on the accounting front, or I can get you to folks like Evan and work that side of it, Brown Edwards is 540-3450936. It's J Dunnavant, Dunnavant at becpas.com. Evan, thank you.
Perfect. I appreciate you being here. Again, that's a wrap for this episode of the Real Estate Tax Playbook. Make sure you're subscribing wherever you get your podcast, Apple Podcasts, Spotify, YouTube. Feel free to share with friends and family, colleagues. Love to have more listeners. I look forward to bringing you more content next month. Thank you.